Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and we're coming to you live at 5 p.m. Eastern, as we always do every Wednesday. It's March 5th, 2025 today, and we've got a lot to talk about, and we've got a great guest to do it with. Dan Fitzpatrick is coming back to the show. He is, of course, the founder of Stock Market Mentor. How long have you been doing that, Dan?
Since 2003.
Okay, so
basically before I when I needed a mentor as opposed to when I could be one, but
Yes, exactly. So from mentee to mentor,
bingo.
better than being a manatee.
This is true.
And look, Dan and I, we live pretty close to each other, but folks, I mean, the weather was just too bad for us to get together. I mean, it did drop down below 60 here.
Yeah.
So, and we've got rain.
I can't see the sun. I mean,
Yeah.
there's blue sky here and there, but the clouds are there too. So yeah, it's horrible.
Yeah. So, well, you know what? We're going to talk a little bit more than just the weather. We're going to actually get into the weather of the stock market. And one of the things that, there's a lot of kind of different methodologies and different acronyms, of course, that we all use in our lives to kind of help keep us on track. And Dan's going to share with us one of the ones that he's come up with. You've got a new ebook that's almost ready to go to press, I guess, in quotes.
Almost.
Yeah.
I thought it was, and then I looked at it again and went, I think this kind of sucks. I better get back to it.
Well, that's your problem. You got to not look at it again. I will tell you, Bill O'Neill. Okay, I was involved with the third and fourth edition, those revisions, and at a certain point, we just had to say stop. He would be changing little words here and there.
Oh God!
And we could have gone on forever. So.
I get that. At some point, you just literally have to say, it's good enough.
But. So let's get into it a little bit. What you've come up with is, and I put this in my tweet as I was writing, Get Smart. It kind of reminded me of the old Don Adams, show that I loved as a kid. But using the acronym SMART can kind of help you go through like a little checklist of what you need in order to pick stocks. So walk us through it if you don't mind.
Yeah, sure. I'm so glad I was able to come up with that acronym, SMART, because it's like, okay, trade smart. Can you imagine if it was like a D and a U and an M and a B or something like that? Okay, so let me trade dumb. So it was something that as I'm trying to craft my own strategy, I realized that I absolutely needed a checklist. And I think a lot of people don't. You may have a stock list or something, but to have a checklist, basically like a pre-flight checklist that pilots use,
right?
I think that's really, really important. I tend to be, this is soda, it's not a beer. I tend to be I'm an emotional person, I have high emotions sometimes. And I needed rules in order to follow, because if I don't have them, I'm going to lose all my money and everybody else's too. So the rules are kind of like the bumpers on the bowling lane that keep my ball in the middle. And so as I learned more and more, I thought, okay, well, let me kind of boil this stuff down. And it all starts with the stock. That's the S in SMART. It's the stock. It's got to be stock specific. And what I mean by that is, like, what is it about this stock that you want to, why is it that you like this? In other words, look for the stock, not for the trade, because there's over 6,000 tickers in play here. And we all have this charting
and
software,
double that if you
and you could just go
count ETFs.
yeah, exactly. Yeah. But like you could just go bang, 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 and look at all these different charts. Well, if you're looking for a trade, you're going to find a trade, just because, as I tell people, the longer you look at a monitor, the more apt you are to do something stupid. I actually use different language, but this is a family show. So it really is important to have a structure going in. And so with respect to stocks, what I look for, I keep scans and screens. I have this stock watch, actually a stock watch tool that I use for different lists. And it's just something that I had to create that works for me and for our members at Stock Market Mentor. But the idea is, what am I actually looking for in a stock? And most of the time, unless it's a day trade or something, I want to find stocks that are attractive to institutions. And by the way, Market Surge or Market Smith, when I first started, that's awesome for finding these stocks that institutions are really looking for, using fundamentals and all the things that people can learn at IBD. And then after that, I have to look and see what the chart looks like. And you can have the best fundamentals in the world, but if the chart isn't good, then that's not something that I can make money on, unless I'm Warren Buffett and I want to buy the company. So I have to see, I start with fundamentals and technicals. And then from that, at that point, I'll get a list that is possible. Like, these are my possible stocks. These are the ones in the bucket that I can go through. Like, this is something that everybody should be doing. They shouldn't just really even be looking at your list or my list or anybody else's. You got to have your own methodology. And so that's really the S part. And then the next part, really, which is, and all of these are important, but it has to start with the stock. But the next one is measurable for M. And what I'm talking about there is, you should be looking at any given chart, and you should be saying, like, okay, what's the personality of this chart? Where are the resistance points? Where are the support points? And you should be able to measure, not bringing out your hope ruler, but just really be able to measure on a chart, where do I think this stock can go? And so on something like that, what I will use, one of the things that I use a lot, it really keeps me out of stupid trades, is I will look at the 50-day moving average, and I'll go back in time and I'll measure the excursions of the peaks. Like, it's got to be an uptrending stock. If it's not an uptrending stock, I'm not looking at it. But in an uptrending stock, you're going to get the bouncy bounce. So in the past, over the past year or 6 months, how far up above the 50-day moving average has the stock gone before it's rolled over or just tapered off sideways? It doesn't have to be a big correction, but basically before the up move is done. And you will find so many times that within 2 or 3 percentage points, it's the same.
Yeah.
Like, I forget which stock I was looking at the other day, but it was like, okay, it's 28%. 26%. 29%. Okay, well, that should tell you something. And so then if I'm looking at a stock now and I'm saying, like, okay, well, this looks like a pretty good deal here. It's in a nice squeeze. Yeah, it's above the 50. And the price is within 23% above the 50-day moving average. Well, that's a stock that I got to stay away from. And because my measurement is what that top would be. And so I don't know if I'm explaining it that well.
No. That's really, really incredible, because Chris Gessel, our chief content officer, once tasked one of our lead programmers, who, it's great when you have a programmer that loves the market too. And he kind of created his own little tool saying, okay, for any given stock, look at that exact thing. What does it do, when it gets extended, how much, and, he just kind of charted it along and gave an average, the instances where the average was. And it really does give you a good sense. And it's so hard sometimes, because when a stock breaks out, what do you use? There's no there's no resistance for you to look at. So you have to have something to kind of let you know, oh, this is, and it doesn't mean that you have to sell it when it gets up to that level, but
no,
it certainly means start being cautious.
Well, yeah, it means that, I mean, it means that you're in a crowd of similarly situated people, many of whom are going to be happy to sell, because that's what's happened before. And so, I found that that's I'd give credit to somebody else if there was,
Mhm.
credit to be given, but that's just something that I kind of came up with on my own, as far as
And
looking at the 50-day moving average. And I paid tens of thousands, if not hundreds of thousands of dollars for that lesson because of
Mhm.
all the money that I lost in buying too high,
Yeah.
you know.
And to your point, it also does give you a sense of that personality of the stock.
Yeah.
What is its typical extension, and that gives you useful information.
Yeah, it does. And especially, if it's a real high flyer, like Palantir comes to mind.
Mhm.
Um, that stock that was a real heartbreaker because I bought it. I made a lot of money on it, like way, way, way lower than it was than it is now. It's one of those where, yeah, I made 50% on the trade, and then it goes up like 200% or
Right.
something.
Mhm.
But this is the kind of thing where as the stock moves higher, it gets further and further away from the 50. But at the same time, if you're not in the stock, you're not thinking about that. You're
Mhm.
thinking about how stupid you're feeling because you were in it at a lower price, or maybe you weren't in it, but you go, oh man, I knew I should have bought that last week or 2 weeks ago, or whatever the case may be. And then it finally keeps going up and up, and you are totally not objective anymore. You've
Yeah.
lost all objectivity. You're just looking at the price. And finally, back in December, you buy it 84.80. And then you get,
37% above its 50-day moving average line.
yep, and you get stopped out at 63.45. And then you bought it again a couple weeks ago at 125.41. The bottom line is, you got to have some way to measure what's my potential reward. I mean, we always say risk first, but you should say risk first, but part of that assessment is like risk as opposed to what compared to what the reward is. And so you got to see a good solid potential for reward from right here from where you're buying. And then on the other side of the equation is the risk. What's the risk? And I just think about where I set my stop is, oh crap, I'm wrong.
Yeah.
Like that's my OCIW level. And that can depend on what exactly you're doing. Sometimes that, oh crap, I'm wrong level, just where you're going to set your stop, your max risk would be like just below the 50-day moving average or something. But sometimes, depending on what the entry is, which is different than the trade, but depending on what the entry is, maybe your stop is, okay, I'm buying today, but if this falls below today's intraday low, this wasn't the best entry, so I'm going to get out.
Mhm.
So you can define your risk that way, knowing that the tighter you set your stop, the more likely you are to get stopped out.
Right.
But that's just part of managing risk.
Yeah.
You can't ever really get this dialed in, to where you've got this perfect methodology for risk management or for exactly where you set your stop. Every chart is a little bit different.
Mhm.
One
You know,
thing, one
to,
thing
to,
I
to that end, I just want to take a moment here and
yeah.
pause because there is something, especially for people that are just starting out, or even worse, if you've been at it for a long time and you still can't accept when you're wrong. You plant your flag in the sand, and especially if you've done like a lot of work on something, you've done your research, and you're like, "This, I've already invested too much to be wrong on this." So maybe
Yeah.
talk about how comfortable you are to be wrong and move on.
Yeah, what do they call that? Sunk costs or
Yeah,
something like that, to
absolutely.
where,
Mhm.
yeah, you just spend so much time and you just know. Um, I don't have a problem. I used to have a problem being wrong, but frankly, that reluctance to be wrong was really just born out of fear. It's a typical thing. I was afraid of losing money. And so that meant that I would lose all of it, because when you're afraid of losing money, it means that you're not going to sell for a loss because that would be losing money. And
Mhm.
so then the stock goes down further, and then you're really afraid of losing money, et cetera, et cetera. It goes all the way down. That I think that hit me. I was that way for a very, very short period of time. And then I realized I was lucky. I realized, well, wait a minute, for crying out loud, I know I'm not a stupid man, but I'm going to be wrong a lot in this game. I'm going to be wrong a lot. And so I better figure this out, and also just know the math. If you lose 10% on a trade, you have to make 11% to make that up. You could do that.
Yeah.
You could do that. But if you lose 20% on a trade, now you have to make 25% to make it up. If you lose 25% on a trade, you need to make what, like 33% to make it up. I mean, the numbers are not in your favor.
Yeah.
And so a good friend of mine said, he's been around forever. He said, I always tell my clients, if you want to be rich when you're older, just don't lose your money.
Yeah. It's just that simple, right?
I mean, that's the macro view of what we're talking about here. You know, if you want to be making money, yeah, just don't lose it. And that's just the way it goes. And I actually, like, I like to start off. I'm a pretty tentative trader. When I first started, I was like, the broker that I was using, everybody there on the floor called me a gunslinger, which I always thought was a compliment. Then I lost all my money, and I realized that being a gunslinger was not a good thing to be in trading. But I tend to trade pretty cautiously at first. I'll start with a pretty small position, because I don't want to be wrong. But if I am wrong, I don't want to lose much money in being wrong. And so I'm willing to wait and have the stock pay me off, basically. Have the stock say, yeah, you're right about me on this one. And then I'll start wanting to build my position. And so what's the time frame for that? Well, if I'm teaching a day trading class, I'll say you may build a full position in 90 seconds or something, because you're just trading that fast. But if you're really swing trading or trying to build a larger position, it may take you weeks or longer to build a full position, because you're going with the ebb and flow. And this is where, like David Ryan, he's a brilliant guy, as you know. He's helped me out a lot. I just listen to everything he has to say. And he always talks about building a position on kind of the next little pause. You know, you'll buy some on a breakout. You know what I'm talking about. Just trade the ebb and flow. And when the stock rests a little bit, it's in a nice uptrend, then maybe add a little more. And then when it breaks out, et cetera, et cetera. And the whole idea is, in my mind, you're always focusing on risk first. And what I try to do, and I learned this really from Mark Minervini, was this idea of financing your risk, where as soon as you can, as soon as the stock will let you, you want to raise your stop to where you've taken risk out of the equation. Some things that I think people make a mistake on in that regard is they'll be too eager to raise their stop to break even. And then they wind up having a lot of break-even trades on what would have been monster trades.
You know, one thing that you mentioned, I just want to kind of make sure I understand, because you were talking about going with smaller position sizes. What is a small position size for you? What is a normal position size for you? Just so folks kind of understand where you're at.
Well, I think, like, for whatever your account is, I want to get to where I've got a position of like 25% in my account.
Yeah.
And that's I've had bigger positions than that. I had a really big position in NVIDIA. It was best trade I made in a long time, possibly ever. But typically, I think the numbers are that if you can get 4 positions of 25%, you've got a you got a good, strong account, and you're going to be really growing that. but I will tend to start out with about maybe 10%. If I'm going to take a trade in initial position, it would be 10%, maybe even a little bit less. But if it's too much less than that, especially if you're managing your risk, it's not going to make much of a difference. If you got two, I know people go like, well, how many stocks do you have? Oh, I have 28 in my account. Okay, well, what are you going to do with that? You've built in mediocrity, that's for sure.
Yeah.
So the idea for me is if I have, say, a 10% position, and then my risk tolerance is maybe 1.5%. I even like to, if I can, go a little bit less than that, but 1.5% of my account value. That's something that I can manage. And that people get confused about this. Oh, you only risk 1.5%. Those are really small positions. No, those are tight stops. You could have the biggest position that you want. But it's just the difference between where you buy, where you're going to get stopped out, multiplied by the number of shares. That number, I try to make sure it's not more than 1.5% of my account, because you could be losing 10, 12 trades in a row, and you're still going to be okay if those losses are really tight. Does that make sense?
Absolutely. You know what? I kind of derailed you, and I feel like we skipped ahead a little bit. We got into a lot of the risk and reward, but I want to back up and go back to your A, which stands for actionable.
Yeah, actionable. By the way, sorry about the cough.
Hey,
I had back surgery,
especially in this cold weather that we have.
Yeah, I know. That's the thing. Like Burr, when you got to take your trash cans out, the blizzard, But now I had back surgery about a month ago, and my lungs are still not quite clear, after all that.
Well, you're looking great.
Anyway, so if I'm coughing,
and you look taller.
I do. I am actually taller.
I know.
I gained an inch, if you could believe that,
Yes.
So it's nice. Nice to be tall. Still can't dunk though. So anyway, with respect to actionable, so I have a method for choosing the stock. Like, okay, I'm looking at this stock. Now I'm looking at the chart, trying to measure, like, would this be a pretty good risk reward? Or to begin with, like, would there be a good reward there, so that I can say, okay, what am I going to do? And then that comes down to the actionable part, where I'll have 3 different lists and it all you want to kind of see them progress through the 3 lists. And I just use a baseball analogy. Trading is a lot faster than baseball. What do I say? It's like watching paint dry in Boca Raton in August. It never dries. But I'll have stocks that are in the dugout, meaning, these fit the technical criteria, but they're not, I just want to watch them. And then ones that are more,
and that might also include stocks that are extended.
Absolutely.
You want to get into because they're powerful, but it's not the right time now. Without you getting your head handed to you. So
that's exactly right. And it can be like, like DoorDash was one of those where we had a couple good trades on this as it was going up, but you could look at this stock in about a month ago, or about 3 or 4 weeks ago. Where it peaked at 125. I will totally keep that on the list, even though when it was up at 215, where somebody else would say, well, I don't want to buy that. I don't want to look at that stock. It's already gone up too much. And it has, but that doesn't mean that in a month from that time, or 2 months from that time, it won't be at a really, really solid level. And so if you have an idea in your mind what a stock has to look like in order for it to be actionable, or as Dave Ryan says, does it have that look, one look that he wants to see? If you know what that is, you can have a lot of stocks in the dugout and you're just banging through them every day. And then sooner or later, you're going to see 1 or 2 or 3 that are on that list of just stocks that could work out. And you say, like, wow, this looks like it could be ready to go. And so then you'll move those tickers into your second list, which I just call on deck, where those are stocks that they're not quite ready for prime time, so to speak, and to mix metaphors, or whatever the phrase is for that. But they're starting to set up. So hey, man, this could work, And there's several stocks that have been in that category lately. But then the last list is the best list, which is, okay, this stock is really, really setting up. This is in my batter up or at bat list. This is the short list of stocks that look like they could be ready to go. All I need is a high volume day, or I need to have my alert triggered, because I'll look at stocks and I'll set alerts all the time, so that I get my attention called back to something that I've just lost track of. It's like having a trading assistant.
Yeah. Mm-hmm.
Anyway, and so those are the three.
And I guess, to that at bat part, maybe the next step, if there is one, is those alerts kind of tell you when the pitch is, when the right pitch is coming, it's crossed this line or what have you, and you're probably looking at the way in which it's crossing that alert, and what else is going on.
No, yeah, that's right. And I mean, my favorite setup is a volatility squeeze where the stock's trading in a pretty tight range. I prefer Bollinger Bands to be squeezed like 5 or 6% within that width. I'd prefer them to be there. And if they're close to the 50-day moving average and drifting they have kind of that look, that's a setup that I really, really like. And so I'll see that. And then what I'll do is I'll set an alert at the breakout level to where if that alert's hit, I would say, okay, well, I want to buy that stock. I typically don't set, I don't set alerts that just like buy stops, if this alert's hit, buy the stock. I think I'd probably make more money if I did, but I think I'd probably lose more money too, because a lot of times those triggers turn out to be fake outs. But I will set an alert at that buy me right here level, but I'll also set at least one alert a little bit below that, so that I kind of get an early warning, like, hey man, look at me, might be ready to go. Yeah. And so, yeah, I really like those. I really, really like to set alerts in that way, because it keeps me in the game when in a particular stock when I should be. But then at the same time, it allows me not to be so preoccupied by having this big old long list of stocks, and I'm always afraid I'm going to miss something. Yeah. Like if I'm setting my alerts correctly, then I have a trading assistant who never goes on a break. He's always telling me.
And part of that kind of comes back down to the stock selection. You've got so many stocks to choose from. You've got to do something to say which ones are going to earn that coveted spot in my portfolio.
Right. Well, and one thing I think that some people, maybe a lot of people don't talk about is a lot of times if you're going to buy a stock, you probably need to be selling something too, unless you have cash. I always like to have cash on hand, just so I don't have to be making choices. But yeah, you have to know, okay, well, if I'm going to buy this stock, well, what am I going to buy it with? And maybe that creates more of a tendency to really look at your trading account, at the positions in your account, with a little more of a critical eye, which can be good or bad. And what I mean by that is, you kind of want to give your stocks room to breathe. Give them, they're like kids, you give them room to relax a little bit and make mistakes and break support and then regain support, maybe consolidate for a while and then move higher. Like NVIDIA, like we were joking about earlier, where, that's that stupid stock, it bore you to tears for 3 months and then blast off and everybody's getting rich off of it. And so, the idea is you always want to be looking at your trading account with a critical eye, always wanting to make sure that you're optimizing it, but at the same time, not over trading, not just getting rid of stuff because, oh, it looks bad today. Because a lot of times, especially in the kind of uncertain environment that we're in now, with respect to geopolitics, and I'm not talking about Ukraine, but just all the tariffs and all this other stuff,
Right.
we could get one bad headline and the whole market dives.
Mm-hmm.
Well, your particular stock that broke support on a broad market sell-off, there's like nothing wrong with your stock because the next day it's right back up. So you want to be able to look and really get a sense of why your position, whatever it is doing what it's doing.
Mm-hmm.
I don't know if that
No,
makes sense.
yeah, absolutely. And let's hold that thought because we're going to get into the market next, but I want to let you kind of finish. I don't want you to leave off at SMAR. So let's get to the T, the time element. And you kind of already alluded to this a little bit. What is that time element for the T in your smart?
Well, the time element, I just say it has to be time efficient. I could actually have a separate T on the end of that, which is track, because you want to track your trades too. But the point is, with respect to time efficient, that really has to do with the entry and exactly where you're buying, because there's stocks that look good. They look really good. But do they look good to buy right now? And if they're going to be buyable right now, it means that they have to have a mature base. And I'm not talking about a big multi-month or multi-year base like Robinhood had a while ago. That was unbelievable. But I'm talking about like just in a regular swing trade type of strategy, you're going to want to see the stock. Yeah, you look at that what was it, almost a year ago, that thing started breaking out above 12 or 13 bucks, and the rest is history. That's one of those I sold too soon stocks, I have to say. I'll acknowledge that. But the point is, it takes a while for a stock that ultimately is a good buy to create a good left side of a base, a nice left down sloping side of a base, and then the bottom of the base, really kind of the bottom of the cup, whatever, and then climb up the right side a bit. All of that takes a lot of time. Yeah. And so if you're buying a stock too early, you're kind of, the way I look at it is, the longer I'm sitting at break even, the greater risk I'm incurring, because it could go either way. And also, the only reason I'm buying a stock now is because I think it's going to go up now. May not be today, but in the next few days. And
otherwise,
so,
what's the point?
Right? Yeah. So what's the point of buying? And so, no, that's for another day. I was going to talk about sometimes on a mental health buy, it's like, okay, well, crap, I know this stock isn't going to go up right away, but I really want to buy some. So I'll buy, a little bit. But the point is, you want to be buying at the right time as opposed to right now. And that means being patient, giving the stock room, giving the trade room to actually unfold. Because if I'm buying too early, I'm not making money. If I'm buying too late, I'm probably incurring too much risk relative to the reward. So,
well, to that end, maybe we can kind of switch over to the market right now, because, I feel like there is an element to that where timing with the market, there are times where it's better to be sitting on your hands because, yes, it might be going up, right now, but when you're in a choppy market, it could be doing a lot of back and forth. And do you want to give yourself that heartache? So maybe we can start by looking at, do you prefer looking at the NASDAQ or the S&P 500 for your market analysis?
I always start with the S&P, but keep it on the NASDAQ though, because the NASDAQ, well, you could look at the difference. Yeah. Okay, the NASDAQ has fallen below, it's really kind of knifing through that 200, where the S&P is really bouncing off of it in a little more convincing manner. I would just, my take on the market, I personally don't think these levels are going to hold. I think they're going to hold for a while. However, I'm reasoning this out. While I don't really think the markets, these levels are going to hold, I do feel like the S&P is going to fall below the 200. I don't really get a vote in that. And so if the S&P stays above there, I'm not going to sit there and be, by golly, I know I'm right on this, because I may very well be wrong. But what I'm really looking at, just to go back to what we were talking about before, is, so if I'm really bullish on this market right now, what's my potential reward? Okay, well, I don't see a lot of reward, because this thing has fallen so hard that I think there's a lot of I want my money back
Yeah,
sentiment.
right.
And so it's going to have a hard time climbing uphill.
So easy to anchor, right? I was at this level. I want to be back at that level again. How do
Yeah,
I get
yeah.
there in the fastest way possible? Especially if you've taken a 10% drawdown or more in this.
Yeah.
And look, you got to remember that the indexes, the way that they came down, it really didn't start getting ugly until this Friday. But before that, we were seeing, Axon, just as an example, that was before the Friday, just, tanking. And
Yeah.
so there was a lot of damage being done before the indexes even showed it. And, when we had our prep call, we were talking about how great financials looked, even, or old Warren Buffett's stock was looking really strong. And then, they kind of come after everything a lot of times.
Yeah. Yeah.
MasterCard, Fiserv, the list goes on of just kind of
Well,
out of
and
the blue.
I think at some point it becomes evident that this is not so much a stock specific market where just the bad stuff's being sold, but
Mhm.
it's more just kind of a risk off, I don't know what's going to happen market, where then just kind of everything's weak, even stuff that maybe in a stronger market wouldn't be.
Mhm.
But one thing I noticed is, one of the lists that I keep is, I call it, for whatever well, I know what reason, is the Fitz Fund Tech Select
Mhm.
list that I have. And it's a list where the criteria is a combination of really, really solid, like really, really strong technicals, and really sound fundamentals. A lot of it's based on Bill's 9x9, at least that's what I call it, his criteria on market surge. And so I'll keep this list and I look through it. And about a week or so before the S&P started breaking down, maybe a little bit more than that, I'm looking through my list, and all of those great looking stocks, they just all started to tank, like
Yeah.
one after the other. And I'm going, like, what is going on here? The S&P looks so solid. And then lo and behold, pretty soon, the wheels come off the wagon.
Mhm.
So I think that the stocks will give you a much better indication of the health of the market than just really truly looking at the indexes. But
Yeah.
the index is a great place to start.
Mhm. Yeah.
It's a really good place to start.
Well, and to that end, maybe we could take a look at a few stocks. I just want to. I'm looking in the YouTube comments, and some people were thinking that we skipped the R. We kind of did a little bit of the R
Oh,
early. That was risk and reward
yeah.
for the R. So just to kind of go over SMART, the acronym: stock selection is the S,
Yeah.
measurable is the M, actionable is the A, risk reward is the R, and then the time or tracking, as you said, element. It kind of wraps things up. So
Um,
um, on the actionable side, one of the stocks that you brought up was something that you have kind of, uh, I guess maybe on deck is this A10 Networks.
okay.
So maybe talk a little bit about how this went through your process.
Okay. Yeah, that's a good one. And I can apply a little bit of the risk reward to this chart.
Perfect.
I think it works. So if I'm looking at look at the fundamentals on A10, and they're pretty solid. Not awesome, but they're pretty solid. I don't have a lot of things to pick it apart. If we were just going to talk about this, I'm sure I would. But the thing that I really like about it is the chart looks really, really solid. Nice
Mhm.
bouncing right along the 50-day moving average. And so what we were talking about early, as far as from the time efficient part of trading, like you can see where from the peak at 2189 back on in the middle of February, so that stock's pulled back, not a big high magnitude
Yeah, just
pullback.
6.6% right
Yeah.
now. I guess a little bit lower when it was at its lows.
Yeah, I think it was a little over 10
Mhm.
percent when it was at its lows. But so I would say that 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 left side of the cup, that left side of the base is pretty much formed, and now it's starting to trickle along the 50-day moving average, just kind of starting. But if you look at this right now at 2046, is there can can you envision a chart where from this particular look the stocks just started to blast off higher? I would look at that and say, okay, well, yeah, I've seen charts like that, but for the most part, the outcome that I see of a chart like this is it's just going to grind around sideways for a while longer. It's going to needs to quote do more work to form exactly to form the bottom of the base and then start to come up that right side. And so I would look at this and say, it's not a real, it doesn't pass the time efficient aspect of the approach, because I think that the stock over the next week or more, the stock can be down at 20. It might be up at 21, but I'm not going to make a lot of money buying the stock at 2046 and selling it at 21. I want to
Mhm.
see more of a completed base so that it's a real strong foundation from which to spring. And but if we want to go into, if you want to, does that make sense? So I'm
Yeah, no,
looking at this
absolutely.
like,
Yeah.
yeah, man, this,
Mhm.
I think this stock, I think
And it
this
doesn't
stock
need
goes
much
higher.
time to look right. It really doesn't. It could do it in a week or so,
Yeah, yeah.
just to kind of get that symmetry there. There is an element of symmetry that often happens with these patterns.
Right. Yeah.
Mhm.
There should be an element of symmetry. Now what we see is the possibility of an
Mhm.
element of symmetry.
Yeah.
So it's kind of like it's not really quite mature. And if you look at this and compare it, say to where it was last October, where it was forming that handle,
Mhm.
that is a great setup. Okay,
Mhm.
well, this is not that. What's happening now is a different kind of setup. And I do think this could run really nicely, but it's just not quite there. And one of the things, if you want to go, yeah, exactly. But like if you want to go to the weekly chart, Justin, this is
Mhm.
my favorite thing that you guys just put on, and that's that earnings line.
Mhm. Yeah, so the earnings line is this green line. For those of you that aren't looking at the video, it basically just tracks what the trailing 4 quarters of earnings have looked like, and
Hmm.
you plot that along, and it gives you a sense. Okay, is the trailing 4 quarters going up? Or is it
Right.
going down? Are the fundamentals improving? And you can also get a sense of how stable it is. Is it something that's kind of all over the place, or is it something that has a more stable earnings line.
Right. Yeah, and this is starting to trickle. It's just continuing to drift up.
Mhm.
But I don't want to beat the dead horse, but so I think we're a little immature in actually buying. But if you want to go to the daily chart, though, now let's get back to this risk versus reward thing. Maybe zoom in a little bit so that those that are watching at home can
Mhm.
see what I'm talking about. But so if I'm buying the stock right here at 2046, where's my where's my potential reward? It could go up to 22. That would be the high on February 18th. So this thing could go up to 22, but then of course it'd have to climb through all manner of resistance back at like 2085 or so to kind of come through this little consolidation. But this could go up like to $22. If I'm expecting it to go up higher than that, I'm engaging in magical thinking. And there's no place for that in trading. So I have a potential 7.5% reward. Now, where's my, oh crap, I'm wrong about this level? Okay, that would be, I would have to say, what, a little bit below the 50-day moving average? It should, because that's where the stock rebounded yesterday. So just below the 50-day moving average, you want to put it, I don't know, 1945, something like that. So that's what? That's 5%. So I have and you have to assume that prior resistance is going to hold. So I have a maximum potential reward of 7.5%, and I have a loss, a maximum, or I guess you could say it, yeah, I'll say it, a maximum risk of 5%. Well, I don't want to risk 5% in order to make 7.5%.
Right.
And that's theoretically, that's the high. What are the chances of me making that? Not anytime soon. So that's where I look at the risk versus the reward. And what I want to see at a bare minimum is 2 for 1. I want to have a potential to make $2 to risk 1, but that's really on the low side. I mean, ideally you want to get like $3 for every dollar that you risk. And if you can because you're not going to be you're going to lose a lot of dollars. You're going to take a lot of losses.
Yeah, you're going to be wrong a lot. That's just part of the game. But
if you're doing if you've got a 3-to-1 reward versus risk, you can have a really, really low batting average and still do really, really well. And so that's really what I'm talking about is look and see objectively, like just be realistic. What's the potential reward that you can look at this trade and say, yeah, I think it can get up to that level. And you need to be logical and you need to be reasonable. Don't be optimistic, be realistic. So what's that potential reward? Yeah, I think it can get up there. Okay, how much do I risk in order to get in this trade? And that also has to be logical. I think, doesn't Jim use a 3, a 5, and a 7% stop loss?
Jim Ropel.
Yeah, which makes a lot of sense to me. He breaks his positions into thirds.
And to be honest, and I saw Bill do this too, that's kind of like your minimum. A lot of times if something just doesn't look right, well, why wait for the 7%? Why wait for the max loss? You can just say, hey, this isn't working. Something changed in my assessment. I identified something that's not right. I'm out. And you shouldn't have to. You shouldn't say, well, I set the stop there, so I'll just wait to see. I'll wait till I lose the maximum amount of money. Right?
Yeah, exactly. You should be. I think you should be entering the market depending on how active you are. I think some people do just fine by just looking at closing prices at the end of the week or something for longer term stuff. But in my mind, you should be showing up every morning and looking at your positions and making a reassessment and saying, am I still right on this? Do I still feel good about this? And if you do, then, stick with it. But if you don't, then maybe you need to take some action, reduce the position size.
Yeah. So you know what, here's another stock that you were talking a little bit about being maybe closer to being at bat. So maybe kind of walk through the difference on this one.
Yeah. So, I love this IPO. One of our,
and this is Waystar Holding, W-A-Y.
Waystar, W-A-Y. Yeah, I wasn't even tracking this stock, and one of my members asked me about it the other day, and I'm going, wow, where you been?
Yeah, look at that.
Yeah.
And again, it's kind of like what correction in the market? It's
and isn't it funny? The IPOs, a lot of them do just ignore. The market. They're like the petulant kid, It's like, I don't care.
Right.
So, yeah, but so you look at this, and today's move was 4.34%. 4%. So if I'm buying, I have a position in this, full disclosure, but I bought it a couple days ago. It's a little bit lower. I'm up 3% on it or something. But like if you're buying the stock now, you have to look and see the volume, like the trading volume, just based on the last 20 days. I don't know what your volume average is,
It's up
but
50.
it's
Yeah.
about half the normal trading volume over the past 20 days. But you can see there's been a lot more activity over the last month or so.
Yeah, right around that earnings really spiked, but you
Yeah.
had a number of spikes in here. Again, not sure
hmm
why, but mhm.
Well, yeah, and it's interesting. So the stock went, all up and down and all around on that earnings, and then it corrected back to almost 40, but it's held. And so this was a case where I think there was so much pent up potential selling, like sell into strength. I forget. I wasn't really tracking the stock, so I don't know. Yeah, I guess the earnings were great. What, up 164%
Not too
from
shabby,
the
and that's
same?
that's not off of necessarily like a penny. That was 11 cents to 29 cents. So you
Yeah,
got some real numbers there in the sales. 18% growth. Off of 200 million it looks like. So
yeah.
244 million. So not bad.
I mean, not bad at all. And there's everything to like about that. They beat the surprise by 110%. So this thing really, as the saying goes, surprise to the upside. So what happens? Traders are going like, great, this is my opportunity to sell into strength. I got just what I was looking for. But so
Mhm.
now, since that time, I mean, the stock's back almost to where it was.
Yeah.
So this is, to me, this is a real key tell when a stock really kind of blows off a little bit, has a pretty meaningful correction after earnings, but then it stops. Then it just starts forming another base. Then I look at this as a stock that there's every reason, if you just look at what the earnings numbers were, there's every reason to think that this stock's just going to continue to run. And you look at the chart, you look at the fundamentals. I like this. But then to look at this from a risk reward standpoint, where am I going to put my stop on this? I probably got to look at the 50-day moving average, and that's about almost 9% below where
Mhm.
this is here. And so then for me I look at and say, okay, well, what was that last high? Maybe 10% higher from where it is now. So now I'm on a 1-for-1 risk reward from the very high. There is what I'm talking about, not a closing print. And that's not a real good risk reward for me. But does that mean that you just say, okay, well, forget it, I can't buy that stock? There are reasons not to buy it, such as, do I think the stock's going to move tomorrow, or is it probably going to sit here? So from a time efficiency standpoint, I probably didn't need to buy this stock
Mhm.
because I think it's probably going to sit around for a bit. But from a risk reward standpoint, I can say, well, I don't need the stock. It's like what you were talking about just a bit ago, Justin. I don't need the stock to fall down to the 50-day moving average to tell me I'm wrong.
Yeah,
Um,
right.
I can have it fall below today's intraday low of 41.73. Okay, well, now I've cut my risk down to below 5%
Yeah.
on this. So the point is on this, know your why. Why are you buying this stock right here, right now? And I would not say, I'm buying this stock now because I think it's going to hold above the 50-day moving average. Okay, well, of course it's going to hold above the 50-day moving average. It's been doing that forever. But rather, I'm buying this stock right now because I think today is kind of a key breakout day and I want to be in this stock. And the only way that I'll have to reassess is if today turns out not to be a breakout day and today's intraday low is violated. So then
Yeah.
I'd put my stop just a little bit below there. To be
Mhm.
clear though, I don't think today's a breakout day.
Mhm.
The volume's too low. I think it needs more time to. I think it just needs more time to kind of calm down and tighten up a little bit more. But does that kind of explain it more on as
I
far
think
as
so. I
the
think it's
risk
great.
reward?
Again, you went through your process, your checklist. I like that you used the pilots as an example because that was something that Bill loved to do. Pilots have their checklist because
Yeah.
you don't have your checklist, and guess what? You miss that one thing, and you know then you're dead.
Yeah.
So you got to have your checklist so you can survive in trading. And I appreciate that you walked us through a couple examples to see exactly how you get that risk reward. So thank you so much for coming on. And
Oh,
for folks that want to follow you on X, you're at
oh yeah.
Dan Fitzpatrick, and then also to go to stockmarketmentor.com, right?
Yeah, you could go to stockmarketmentor.com. Yeah, my X handle's really complicated. It's Dan Fitzpatrick.
Right.
But yeah, if you go over to Stock Market Mentor, if you're not on my email list, it's free. You can get on there and you'll get a chart video every day. But I'm going to be switching that into distributing an ebook that I'm writing. I'm just about done with it, and it really covers a lot of the things that, well, this and a lot more. And so I don't spam anybody. I'm too busy for that stuff. But if you want to get like first crack at that ebook when I'm done with it, it'll only be another week or two. Then go ahead and get over there and have at her, baby.
Right. Well, thank you so much for being on the show, Dan. Glad to see that your recovery's doing so well. And
Yeah,
maybe one of these times when the weather improves, we can get together. So,
love it, baby. We'll go
okay.
skiing down the street. All right, man. I'll see you, Justin. Thanks for having
being
me.
on.
All right, we'll see you.
That's gonna wrap up our show today. Thank you so much for joining us, especially those that joined us live on YouTube. Again, we're on every Wednesday, 5 p.m. Eastern time on Wednesdays. And please join us next week. We're gonna bring back the Hat Man, David Chung, our deputy markets editor. Always a great time chatting with him, and he's one of our hosts on IBD Live, and has a lot of great information that he's going to share. So we'll kick the tires on that next week and go through what's happening in the market. Hope you join us. Thanks for watching. Bye bye now.